think we're getting a rally at the end of the year.
Whether it's crypto or stocks, I think it's time for a rally. Here's why. The VIX is starting to break trend, and you know what that means, a snapback rally. The RSI is starting to turn up on the daily and weekly charts. Positive RSI divergence marked the bottom in 2008 and 2015. Support and consolidation on the 200 weekly average for about 4 weeks. We got bullish capitulation against the June lows, and a reverse head and shoulders with a breakout above 380.
We've been bearish all year, and it's time for some relief.
Now, if we do break 380, the target's around the 200 daily moving average or the bear market support trend. In order for markets to sustain a move back to the trend, you need these next two macro forces to stop going up.
So we need to see rates start to peak out before we can really think that any sort of rally has some longevity.
One of the reasons interest rates keep surging higher is because there's a lack of buyers in the bond market.
One of the biggest stories that I don't think gets nearly enough play on television, or I assume among your viewers, is the illiquidity in the Treasury market, which has risen to such a degree that Janet Yellen is talking about it.
Yeah, but it sounds like that might be changing soon.
The Treasury Department is on the verge of doing a Treasury buyback. Later this year or early next year, they're probably going to introduce a program where they're going to start stepping in and buying off-the-run Treasuries.
Because who else?
So if the US Treasury does start purchasing back bonds, that should push interest rates lower, or at least not move higher. Please like and subscribe for more content like this. The other force keeping rates higher is about inflation.
We're not even sure that we've got rates high enough to push services inflation down. So until I see some compelling evidence that core inflation and services inflation have at least peaked, I'm not going to be ready to declare a pause.
But the Global Supply Chain Pressures Index tells us supply chains are easing. Supply chain pressures eased for a 5th consecutive month, and year-to-date movements suggest global supply chain pressures are beginning to fall back in line with historic levels. Energy inflation is dropping like a rock, and Joe Biden is still pumping reserves.
The Department of Energy will release another 15 million barrels from the Strategic Petroleum Reserve.
Inflation's coming down now. The market's going to see the Fed is done and inflation's falling.
So as inflation eases and the technicals line up, we really want to keep an eye on interest rates. Where's the peak?
My own work suggests rates are very close to peaking out.
We're not calling for rates to fall down, but maybe they just stop going up. That can be enough for, once again, equity markets to get excited.
Will the US Treasury really buy back bonds? This could be the signal.
Later this year or early next year, they're probably going to introduce a program where they're going to start stepping in and buying off-the-run Treasuries.
Because who else?
Check out the comment section. We'd like to know your thoughts on the market.